as you feel my mind, or you feel my mind. We could build a dream, start up something new, and the world is on your shoulders, and you feel like falling over. Just let me in your head, so I can be there for you, there for you. The night is young, won't you sing for me? Won't you sing for me? Till we fall asleep.
Hello, everybody. Welcome to VC Masters on the Pod TV network. I'm Nick Palavito. I'll be your moderator for today's show. And today we're going to look at, of course, the breaking news in the VC market. As we well know, IPOs are up about 85% this year, which I found to be quite shocking. A lot of the activity is done in the healthcare sector, a lot of activity in technology sector, and a lot of technology in the fintech center. So what we're seeing is a lot of momentum if you're in the right sector. Health, technology, fintech are the big sectors. But with that, we'll bring somebody who swims in this sector, none other than our friend, Dr. Salman Azhar, who's a professor at Duke University and heads the Azimuth Fund. So maybe he can give us a little more breaking news on what's going on in the world of VC capital. Dr. Azhar, it looks like, you know, that people are taking their companies public when, you know, the waters are choppy in the stock market, but they're forging ahead. So it looks like there's opportunities right now in the VC market.
Definitely. In fact, we were expecting it to be even higher than 83% up. 2024 and even 2023 was a really, really bad year. So just a quick introduction. I am GP of Azimuth Fund and also Duke faculty member. We focus on pre-IPO companies generally that are going public or getting acquired in 1 to 5 years. And we can get very good discounts on the fair market value for buying shares in these companies. Now, what happened in 2020 was that COVID basically jammed up the entire IPO market. And then after COVID passed, there was a brief window that was again closed by inflation. And inflation is really bad for new companies going public. So that market has been kind of backlogged for some time. 2024 was one of the worst years because people were really concerned about the uncertainty around elections and so on and so forth. And one thing that we expected with Trump taking power was that the IPO market would just start flooding, and which is, by the way, great for us because we want these exits. We want to get the cash back and we want to reinvest into other companies and so on. And just turn the money around and just live a better life. I have a friend that is like 75 years old, and he's saying, "Hey, I just needed cash back. I don't mind selling my shares at a discount. I just need the cash back." So, and that was the expectation until the tariff news hit, and that kind of slowed things down a little bit. But you know, it's a very resilient market. You know, 10 years ago, something like tariff news would have taken 4 years to kind of recover, or 4 months to recover. You know, it would be like a long time, and it just took 4 weeks. And companies are now going IPO again. The process of going IPO is essentially for a company that is privately held to be tradable on New York Stock Exchange or NASDAQ or some other publicly traded platform where everybody can participate and buy shares. And what that does is it gives cash back to the company. So we are just seeing the tip of the IPO market. There is still a huge backlog. I'm expecting that next year would even be more IPOs, and you know, it will take us a few years to catch up with all the backlog of the last few years.
Yeah, one thing I also was looking at, I don't know if you looked at this, Dr. Azhar, is that the increase of IPOs in Hong Kong. In other words, Hong Kong looks to be one of the fastest growing economic centers in the world because they're to overtake the New York Stock Exchange when it comes to IPOs. What are your thoughts about some of these international markets? In other words, in the United States, you think New York Stock Exchange, but London's very active and Hong Kong is extremely active. So when somebody's looking to take their company public, should they look international and not just domestically to the United States?
So if it is an international company, especially if it's headquartered in Asia or Europe, it would make sense for them to do that because they will get better traction in a number of ways. They're going to be a household name. There are companies that I don't know about that may be huge in China or huge in England. And it makes perfect sense for them to go public in markets that are closer to them. That conventional wisdom was very different, again, before COVID and, maybe 10, 20 years ago, because New York was the way, and New York has several exchanges, incidentally. So when I'm saying New York exchanges, I'm not talking about NYSE or NYSE. I'm just talking about like generally going public in one of the New York stock exchanges. That was the default, but that has changed quite a bit. And there are some companies that would have dual listings. So for example, Alibaba is a Chinese company that is listed in Hong Kong, and it is also listed in US. And there are companies that are listed in multiple stock exchanges. There's usually a primary listing, and there is in US what they call ADR, American Deposit, I think, registry, where you can buy shares in Alibaba, for example, and it would translate to the performance of Alibaba internationally. So I think that is going to, the international markets are going to be becoming more competitive for us as Americans. I would obviously like all these companies to go public in America, because that offers Americans a wider choice, because we can't invest in, let's say, Hong Kong Stock Exchange directly unless, we have, we have to like convert currency and all that stuff. And a lot of brokerage firms don't support that.
Yeah. Okay, but we're talking about the companies that are IPO, and the publicly traded companies I get a lot of information on, and I can trade them. I noticed my position in Micron just went way up. I may have had a limit sell order, which means I may have got out already. But you can get a lot of information on publicly traded companies, even IPOs. But what about the startups and the private equity and the venture where you can really hit home runs? In other words, how do you get information on these early stage companies? It's just so tough. How do you get your information on these companies?
Yeah, so for us, we are invested, between my partner and myself, we are invested in about 300 companies. So we get investor reports, board meeting minutes, and so on. So we exclusively dedicate ourselves to really studying them, because we have inside information that we don't have on other companies. So there is like a lot of activity, for example, in SpaceX shares, and a lot of people are trading them on public websites like Hive and Forge at a significantly higher valuation than they are worth. And the reason for that is that, Uber drivers, and nothing against Uber drivers, but like people who are not investment specialists are buying these companies on Hive, Forge, and so on and so forth. So we exclusively dedicate our time to studying the companies that we are invested in, figure out where we want to increase our stake. And by the way, that's really kind of counterintuitive for a lot of people, because a lot of VCs these days are trying to put the companies that are not doing well on life support. And really, a smart investor cuts their losses. I mean, you talked about Micron, for example. If Micron is going up, let it go up. Yeah. Don't sell it. If Micron is going down, that is the time for you to say, okay, I'm going to cut my losses. So the people talk about dollar cost averaging up. I really talk about dollar cost averaging down, because companies that we know are doing well, that are growing at, let's say, 50% year over year, effectively that means that any investment that we do would grow 50% year over year, which means we would more than double our money every 2 years.
Yeah, and I work with a lot of financial advisors. I have about 90 of them that work with our pension company, and I work with, and we beam to a lot of certified financial planners. And they always talk about asset allocation. In other words, put a certain amount in safety, like in bonds or annuities, certain amount in the stock market, and then certain amount in alternative investment, cryptocurrency being one of them, which I'm not a fan. But startups and venture capital, I am a fan. What is your thoughts about financial advisors talking to their clients about allocating a certain percentage of their asset base into venture capital and private equity?
So it makes all the sense in the world. The challenge is that most financial advisors do not understand the VC or even private equity. Private equity, by the way, is a little bit easier to understand. VC is something that a lot of financial advisors don't understand. Like, for example, I had a friend who is about my age, actually a little bit older, and his financial advisor was telling him to kind of convert everything to income stocks and so on and so forth. And the income stocks hardly keep up with inflation these days. And if you and bonds are even like, I know there's a whole industry of bonds, and the only way to make bonds, money in bonds, is get commissions and advise people to buy bonds, because they hardly keep up with inflation. So the education has to be to the financial advisor first, so that it can understand VC. And there's one key concept of liquidation preference or preferred stocks. If people can just understand that, it would just open the floodgates into venture capital. And liquidation preference kind of goes like this, and I may have explained this earlier, that let's say a company is worth $8 million, and you invest $2 million into that company as a group. Usually one person doesn't, but let's say a few investors get together, invest $2 million. That means that you own $2 million of $10 million now. 2 plus 8 increases that value of that company to now $10 million. Because you have 8 million value before and 2 million in cash coming in, total value is 10 million. Of that, 20% now is owned by the investors. Now, people think that if the company sinks 20%, you will lose 20% of your 20%, which will leave 16%. But that's not the way it works. Or if company, actually, let me make the math easier. If the company is cut in half, you would lose half of what you invested in. Your 2 million would become 1 million. The way liquidation preference works is that the investors get their money back first. So if the $10 million company goes to $5 million, the investors still get their 2 million back. And that people who had the 8 million before that would actually bear the entire brunt of that 5 million loss. So their 8 million would go to 3 million, and the investors' 2 million would stay at 2 million. So effectively, if you invest 2 million in a company with 8 million total value coming in, you are protected for that entire 8 million going to nothing. Now, hopefully that doesn't happen. Hopefully what happens is the company doubles, triples, 10x. Like one of my investments had 171 times or 171x in VC speak return, which means that for every dollar that I put in, and people who invested at the same time as I did, we got $171 back. That kind of pays for all the risk I have ever taken.
Yeah, I agree with you. That's something that people don't understand when it comes to investing. If you hit the right targets, it covers all the losses. I've been down that road before. But here's the other problem that I don't know if you've faced with the Azimuth Fund, but people have faced in general. It's called the Securities Exchange Commission and FINRA. Okay, and here's one of the problems that we have as we talk to financial advisors about certain investments. If they're not approved by their broker-dealer, quote, approved by their broker-dealer, then they can't offer it to their clients. So are the individual investors basically shut out for the most part because they rely heavily on their financial advisor, and the financial advisor looks and say, hey, that's not approved by my broker-dealer, so I can't handle that product. Have you seen that before? In other words, the BDs, it's not approved by the broker-dealer, and hence, poof, we can't even discuss it. What's your thoughts?
Yeah, no, absolutely. So the problem with broker-dealers is first that they are, well, actually, there's a lot of good about broker-dealers, but the problem with broker-dealers is that only a few of them would address really VC work, and most of them would have more the standard kind of offerings where they would be selling publicly traded companies or pooling money to buy something. They are not usually as sophisticated. The other challenge with broker dealers is for companies like us that they want a retainer, and we have been burned so much by retainers that we don't work on, we don't give retainers, because a lot of broker dealers would take the retainer, not sell their product, not sell our product, and our money would just go to waste. So we are happy to pay them a percentage of the money that raised. That is absolutely no problem. So success fee is absolutely no issue. Legally, we cannot pay Tom, Dick, and Harry success fee unless they are registered as a broker dealer.
Right.
Yeah.
Right.
So that, when it comes to publicly, and this is really, archaic laws now, right? We are talking about when it comes to publicly traded companies, people buy, all kinds of publicly traded companies. Like, somebody may have bought UHC a few months ago and it's cut in half, right? Nobody really cares. And they made as uninformed of a decision as they would by buying a stock. Now, VC world is actually a little bit better because the only way you can get access to the best deal is to work through other VCs who know what they're doing and who are putting in their own money. If a VC is not putting in their own money, they have no right to ask for your money. Absolutely not. I mean, actually, you should. That's a scam, right? So generally, if you are kind of Joe Q Public or Jane Q Public, you should be talking to a VC and saying, "Hey, how can I invest money with you to get the best returns?" Because they know what they're doing. So and there are like all kinds of people that try to make these decisions, and our success rate with people who try to go to data rooms and try to figure out what has taken us years to learn. It's like, if I just had a physical checkup, like it's me telling my doctor, "Hey, I don't need a PSA test, which is prostate for cancer, because I'm fine," right? And I have done research on my Google, or I have done research on ChatGPT, and I have concluded that I don't need this particular test, or I don't need to, even go for a physical annually, even though that's basically what the standard recommended practice is. My general practitioner reminds me, and by the way, I have a physical later this month, so that's the reason. Kind of like, I'm not going to go tell her that, I looked at all these research and medical research, and hey, I don't really need to take any tests. I don't need to. I'm fine. I feel fine. I'm fine. And that's one of the challenges that a lot of amateur investors have. And then, there is this thing in VC industry that we don't lie to each other. And a lot of amateur investors and a lot of world is made up of lies. They, if you don't like my investments, tell me, like, you don't like my investments. One person basically told me, my diligence team reviewed it, and they wanted to know sources and uses of cash. And I'm like, does your diligence team knows what a secondary is? Because in secondary, you're not investing into the company, you're buying existing shares. It's like when you go buy Google shares, you don't ask Sundar, "Hey, what are you doing with my money?" Because Google is not getting that money. Nick may be getting that money because Nick is selling those shares. So they're like all kinds of pretenders who don't know anything, and then they don't know anything. And they make up this diligence team. I mean, no diligence team in the world is going to tell you that we need to ask for sources and uses of money for a secondary offering, because it's not going to the company.
Right. Okay. And let's talk a little bit about accredited investors. In other words, the thing is, the regular investors may have to go through attempt to go through their financial planner, who gets blocked by their broker dealer. But what about accredited investors? Can accredited investors go directly to you to discuss the opportunities in private equity and the venture capital market?
Absolutely. And basically all our investors, and there, by the way, there's a new regulation that one of my broker dealers that I'm working with is going to market for us, which allows for non-accredited investors to also be approached and invest. But bottom line, what you asked is that if you're an accredited investor, and you can just Google accredited investor, there are some income requirements and there are some net worth requirements, and there are multiple ways for you to qualify as an accredited investor. If you're an accredited investor, my suggestion is go to your favorite VC and talk to them and at least understand what the VC offering is. The 60-40 portfolio is dead. Like, nobody does that anymore. Nobody smart does that anymore. And it shouldn't be done because it really depends on what your risk profile is. Now, I have my oldest brother, his risk profile is very conservative. He just wants, capital preservation. And I tell him, look, VC is for you and we can preserve your capital, but we can't guarantee it. You want to guarantee preserving capital, you keep your money in an FDIC insured bank, and they will guarantee your capital, I think, up to 250,000 now. It used to be 100,000. Now it's up to 250,000. And if you have more than 250,000, find another bank. So If you have $10 million, you should put $250,000 in 40 banks, and that will preserve your capital, nothing else.
We're going to talk about another type of investor since we broadcast to about 120 countries, and one of them you've met on the show, Shaquille Latmer, who, as you know, runs through millions and billions of dollars overseas. He's kind of famous for that. But he's a different cat. He's an international investor. He doesn't specifically invest in the United States. He takes opportunities all over the world. What is your thoughts about this new cat, the international investor?
We are getting an increasing number of international investors. So, 20 years ago, there were very few. And now we are getting a lot of interest. There is a lot of money coming in from the Middle East, Europe, Asia. In fact, a lot of my friends are raising more money internationally that they are raising within the United States. And that's, by the way, great. I think that really expands the reach of these companies. It gives them an international network. So, for example, two of our companies are very active internationally, and getting an international investor can be a good strategic partnership for them as well, even if they are buying existing shares and they're not doing a new round. If they are going into a new country, it would be great to have like a major investor in that country that shows around things. One of the companies that we have does a lot of business in Mexico, and a Mexican sovereign fund is invested in them, which actually makes it great. It's a U.S. company, and that gives them the ability to operate in Mexico without exposing themselves to all kinds of issues or risk that would come in as operating in a foreign country, where the government may even start cracking down on it. But if the government is invested in you through a sovereign fund, they are not going to shoot themselves in the foot by killing you.
When you're looking at companies, let's talk about the size of the companies you're looking at. There was one company I was talking to the other day that their minimum was $50,000 a month. If they're not bringing in $50,000 a month, frankly, they're not interested, which is only about like $600,000 a year. So I would assume that would be correct, because if you're not bringing that type of money, it probably isn't a company that's going anywhere. So what are you looking at in terms of minimal cash flow from the companies that you're working with in your private equity and venture capital fund? Cash flow.
Yeah, so we are looking at the annual revenues between 50 million and 500 million. And we are looking for companies that are either cash flow positive already or are going to be cash flow positive this year. And really, to back up to that, the reason we are looking for that is these companies don't need another round of funding. And if they don't need another round of funding, our shares don't get diluted, because there is a dilution that takes place if there is any new money that comes into the company. Let's say somebody buys 20% of the company, then our original 100% actually now shrinks to 80%, which is a dilution thing. So we are looking for companies that are cash flow positive or already, or are cash flow positive in 2025. And 50 million is the minimum. 500 million is kind of the maximum, not because we want it to be the maximum, but companies that are pulling in more than 500 million are either already public or so close to being public that we don't get the 40% discount that we want on the fair market value. So, So okay. This is actually, you said this. I mean, this is so true. We make money when we buy into a company, and what value we get. And our criteria is that whatever the fair market value is, that we are going to pay 60% of that, which means 40% we are making right off the bat as soon as we invest. And that gives us a great thing to be. When company has more than $500 million, they are so close to going public that we would get something like 5 to 10% discount, maybe 15% discount, and really it is not worth our time to invest in a company and just make 15% when we enter into it. And by the way, we don't invest in public companies at all. I don't invest in public companies at all as well, because public companies or S&P 500 would give you like single-digit returns historically speaking. High single digits, but maybe 10% is the on the average. It may go up 30% one year, even 50% in a year. I don't know what the limits are, but it can go down also 30%. So on the average, it's 10%. it does not meet our risk reward thing. And it doesn't have any downside protection. So if a company like Google goes down 50%, or actually UHC as a practical example goes down to 50%, it's not like we are protected. If one of our companies goes down 50%, we are actually protected. We don't lose any money.
Yeah, and 50 million in revenue is very reasonable in terms of being able to, as a starting point for these companies. Now, the companies you're investing in, they are private. Would that be correct? They're not publicly traded.
They are not publicly traded. We are looking for companies that would be publicly traded in 1 to 5 years.
Okay, right. Yeah. And the thing is, does your fund hold shares in a lot of different companies? Is that what's going on?
Yeah. So we have several funds and several vehicles, or several kind of LLCs that we hold different companies in. And sometimes we combine several companies into one fund. And sometimes we have specific companies that we are investing in. So right now, for example, there are 2 companies that we are looking at. We are putting together a separate fund for each one of them, for the lack of a better word. Let's just call it a fund, just to make it more accessible for people. And then what we will do is that people who have invested in very single funds, after a year or 2, we give them the option of rolling the money into a more diversified fund. Diversification is good, but it can be terrible as well, right? If you're diversified, if you ask me to buy shares in the top 10 companies that I have, I would do a lot better than if you ask me to buy shares in 50 companies, because I would be kind of like, every additional company would be like a level down. So we are very selective in terms of which company we are increasing our stake in. So out of 300 or so, there are about 5 on our radar and 2 that we are actively investing in, and the other 3 are in the pipeline.
Okay. And if somebody needs to contact you, how do they get a hold of you? I mean, one of the problems I have with VC investing, private equity investing, it's a murky. I go on the internet, I can find public companies all the time. I can buy, sell, everything. But when it comes to private equity and VCs and startups and late stage, hard to find. How can an investor in, let's say, in Australia who's listening to this, or somebody in Bangladesh who's listening to this, or somebody around the world, China, because we broadcast in China, listening, how do they get a hold of somebody like you? You have your little thing there, but sometimes people like you are hard to get a hold of.
Yeah. No. So I want to be very accessible. My whole purpose of like having this fund that is like relying a lot on individual investors is actually to serve people like my son, who did very well in their early career, had a company that went public, has money to invest, and his friends and stuff. So I'm very accessible. You can go to azimuthopportunity.com, Azimuth, AZIMUTH, and then opportunity, just like opportunity.com, and you can find the contact form there. You can also email me at salman@azimuthopportunity.com. And if you don't remember this, just remember my name. You can Google me. You can find me very easily on LinkedIn. I'm usually the first Salman Azhar that shows up. And you can also see, I'm happy to share my portfolio of companies and what I've invested in. If somebody is like, is this guy, Johnny come lately or something like that. But there's a lot of people that are Johnny come lately in this that are selling, basically selling companies that are failing, and you can get like 90% discount on those, because they are just going to be out of business next year. So so just be careful. There's a famous saying, I've forgotten who said that, but said only people with a history have a future. And in financial, when you're trusting people to your money or your life, trust them with people that have a history of doing what they're doing. They're not just like trying to come out of under the rock or something like that and say, oh, hey, I'm going to start investing in VC.
Yeah, no, I think that's very important, but I also think diversifying is important. So a lot of our clients, I can tell you, they're not diversified at all, and they're not into this sector at all. But I find it to be fascinating because of one of my associates, who was an original founder of Uber, which I told you about. He put in 25,000, took out 140 million. You're not going to get that return in a late stage publicly traded company. It's just, as they say in Pawn Stars, it ain't happening. But you can get it in early on investing if you know what you're doing, or you find somebody like you who does know what you're doing, hopefully we can get you on another show called Ask the Experts, which is going to be broadcast through our new license through TikTok, believe it or not, because we've been getting 6,000 to 20,000 people an hour on those shows. We just beta tested it. I'm going like, wow,
Awesome.
That's a lot. But apparently it's a pretty big, fast moving show. But we do want to thank Dr. Salman Azhar for enlightening us, because the people, in the United States and investors, they just don't have access to this information. But we appreciate all your knowledge, and please contact him if you do. And we'll see you next week on VC Masters on the Pod TV network. Take care.
Happy to be here.
I go anywhere with you, 'cause you fill my mind, or you fill my mind. We could build a dream, start up something new, and the world is on your shoulders, and you feel